Bank of America, one of the most respected financial institutions in the entire world, just published a research report with a price target on silver. That target, $309 per ounce. $309. Silver is currently sitting around $61. That means Bank of America's bull case represents a gain of over 400% from right now. And they're not alone. Citigroup separately called silver, and I'm quoting this directly, gold on steroids, and set a target of $150 to $170. And then on the same day these targets were being discussed, news broke that China restricted its silver exports to just 44 approved companies in the entire country. I want to walk you through all three of these stories today, honestly and completely, because each one reveals something genuinely important about where this market might be heading. And the combination of all three together tells a story that most content isn't connecting properly. This is OG Silver Stacker. Completely new information every single time. Let's go. Let's start with the Bank of America target, because I think the first question most people ask when they hear $309 is a reasonable one. Is this a serious forecast, or just a clickbait number designed to generate headlines? The honest answer requires understanding how institutional banks actually publish commodity forecasts, because it's different from how most people imagine it. Major investment banks like Bank of America don't typically publish a single target price for a commodity like silver. Instead, they publish a range of scenarios, typically a base case reflecting their most likely expectation, a bull case reflecting what happens if the most favorable conditions materialize, and sometimes a bear case reflecting the downside scenario. The $309 figure represents Bank of America's explicit bull case for silver, meaning it's not their prediction of what they think will definitely happen. It's their calculation of what silver's price could reach if a specific combination of the most favorable possible conditions all materialize simultaneously. Their base case sits considerably lower, in the range of $135 per ounce. That's still more than double current prices, but it's a very different number from the 309 headline. Here's what's genuinely important though, and this is the part most coverage misses entirely. The fact that a credible major institutional bank runs the math on a bull scenario and arrives at $309 tells you something important. It tells you about the magnitude of potential upside that exists within silver's structural situation. Even if you personally believe the probability of that specific bull scenario materializing is relatively low. They didn't pull that number out of thin air. It emerged from a model that incorporated specific, real, verifiable inputs. And understanding those inputs is far more useful than fixating on the headline number itself. Let's actually walk through what has to be true for silver to reach $309, because understanding this is way more useful than just hearing the number. Bank of America's bull case essentially requires three major forces all hitting simultaneously and reinforcing each other. The first force is a complete breakdown of the COMEX paper market's ability to satisfy physical delivery demands. Here's the specific updated data that feeds into this scenario. COMEX registered silver, meaning the physical metal actually available for delivery against futures contracts, stands at roughly 92.9 million ounces, against total open interest representing several times that amount of paper claims. The coverage ratio sits at approximately 17.4%, which means for every dollar of paper silver claims outstanding, there's only about 17 cents worth of physically deliverable metal backing it up. Exchange analysts describe this as sitting in what they call stress territory. If a significant wave of futures buyers simultaneously demanded physical delivery rather than rolling their contracts forward, the exchange would face a genuine crisis, finding enough physical metal to satisfy those demands, which could trigger a pricing spike of historic proportions. As the gap between paper and physical prices was forcibly closed, the second force is a sustained dramatic collapse in the US dollar's value, driven by either a loss of confidence in US fiscal policy given the extraordinary level of government debt, or by a Fed that eventually pivots aggressively toward rate cuts in response to economic weakness. A dramatically weaker dollar would immediately boost silver's dollar price through the mechanical foreign buyer demand mechanism we've discussed in previous videos, but it would also attract enormous new investment capital into precious metals as a dollar debasement hedge, amplifying the monetary demand side of silver's equation substantially. The third force, and this is perhaps the most underappreciated, is a genuine supply crisis, driven by the physical tightness we're already seeing building in real-world markets, something that China's export restriction, which we're going to discuss in detail shortly, is making significantly more acute right now. All three of these forces hitting simultaneously is admittedly a high bar scenario, but each of them is grounded in real existing structural conditions rather than fantasy. And that's what makes Bank of America's $309 bull case intellectually honest, rather than merely promotional. Let's shift to Citigroup's research, because their language, gold on steroids, is actually more revealing about the underlying thesis than any specific price number. To understand what Citi means, you need to understand what steroids actually do to an athlete. Not in a health sense, but in a performance sense. Steroids amplify the underlying capabilities of someone who is already performing well. They make a strong athlete stronger, a fast runner faster, an explosive jumper more explosive. They don't transform a weak person into a world champion. They amplify existing capability into exceptional results. Citi is saying silver has the same basic monetary characteristics as gold, but with everything turned up significantly. Both metals benefit from dollar weakness. Both benefit from lower, real interest rates. Both benefit from inflation fears and central bank accumulation. But silver's response to each of those favorable conditions is amplified compared to gold because of the additional industrial demand layer we've discussed extensively throughout this series. When rate expectations ease, gold goes up, silver goes up faster. When the dollar weakens, gold benefits, silver benefits more. When inflation fears spike, gold rises, silver rises harder. This amplification is what Citi is capturing with the steroids metaphor. Citi's specific target of $150 to $170 represents their view of what a scenario where these amplifying forces play out over a meaningful time horizon would produce. Importantly, Citi's research was published when silver was trading at much higher prices than it is now, meaning from today's lower price of around $61, the percentage gain implied by their $150 to $170 target is actually substantially larger than it was when they first published it. This is a situation where price declining has made an existing institutional forecast more bullish in percentage terms, not less. Now, let's get into something that I think is genuinely one of the most important silver market developments of the entire year. And it's getting almost zero proper attention in most mainstream coverage. China recently restricted its silver exports to just 44 approved companies in the entire country. 44 companies. In a nation of over 1 billion people and the world's largest manufacturing economy. And let me explain why this is so significant. China is one of the world's largest silver producers and also one of the world's largest silver consumers, particularly for industrial applications in electronics, solar panels, and rapidly growing electric vehicle production. For most commodities, China's production and consumption roughly balance each other domestically, with relatively modest net exports or imports. Silver has increasingly been in a different situation, with Chinese industrial demand growing fast enough that China has actually become a net importer of silver in recent years, meaning it needs to bring silver in from global markets to meet domestic demand, rather than exporting surplus production. Against that backdrop, China restricting silver exports to just 44 companies represents an explicit government decision to prioritize domestic silver supply for Chinese industrial use, restricting the amount of Chinese-produced silver available to global markets. Here's the direct implication. Every ounce of Chinese silver that stays inside China due to this export restriction is an ounce that doesn't reach global markets to help satisfy international demand. In a market already running a supply deficit for 6 straight years, removing an additional supply source, however modest, tightens an already stretched physical market even further. There's also a strategic dimension worth understanding, which we haven't covered in any previous video. China restricting exports of specific critical materials has become a recognizable pattern across multiple commodity categories over recent years, reflecting a broader policy approach of ensuring domestic industrial supply security before allowing surplus production to flow to international buyers. This pattern, when applied to a commodity like silver that has genuine strategic importance for advanced manufacturing and defense applications, represents a structural change in the global supply landscape, rather than just a temporary regulatory adjustment. Here's something even more obscure that connects directly to China's silver supply picture, and I genuinely haven't seen any other silver channel explain this properly. China also halted exports of sulfuric acid, a chemical that sounds completely unrelated to silver, but is actually a critical input in the silver refining process. Sulfuric acid is used extensively in the metallurgical processing of silver ore. Specifically in the leaching process, where silver is separated from the rock, it's found at mining and processing facilities. Without sufficient sulfuric acid, mining and refining operations face genuine production constraints, because you simply can't process as much ore through your facility when a key processing chemical is restricted. China is a major global supplier of sulfuric acid, and its export halt has created supply challenges for silver processing operations in multiple countries that relied on Chinese sulfuric acid as part of their refining supply chain. Think about the layers of this issue. First, Chinese silver production is now being kept domestically rather than exported. Second, the processing chemical needed to refine silver from ore at facilities in other countries is now harder to source because of China's sulfuric acid export restrictions. Both of these effects work in the same direction simultaneously, tightening the physical silver supply available to global markets from 2 completely separate mechanisms. This is exactly the kind of multi-layer, interconnected supply constraint that doesn't show up in simple headline data, but that people who dig into the actual physical market mechanics can see building underneath the surface. Here's something that should honestly shock anyone who's been following silver markets, because it reveals just how diverged the paper price of silver and the actual cost of buying real physical silver in some major markets has become. In Dubai, physical silver has been trading at a premium of approximately 38% above the COMEX paper spot price. 38%. That means if you walked into a Dubai bullion market this week wanting to buy actual physical silver bars, you would be paying nearly 40% more than the price you see quoted on every financial website and news ticker. For context, premiums of a few percent are completely normal in physical silver markets to cover refining, minting, dealer, and shipping costs. A 38% premium is not normal. It's an extraordinary signal of physical supply tightness in that specific region, where actual buyers willing to pay real money for real silver are bidding up the price substantially above what the paper futures market quotes. Because the physical metal is genuinely hard to obtain at anywhere near the paper price. There's also a similar, though somewhat smaller premium visible in Shanghai. The Shanghai Futures Exchange, which is China's own domestic silver futures market, has been running at a premium of 12 to 13% above COMEX prices for an extended period. This SHFE premium is significant because it reflects Chinese buyers in the world's largest manufacturing economy consistently willing to pay more for silver than the price the rest of the world sees. Specifically because Chinese industrial demand is so robust that buyers there are competing more aggressively for available physical supply than anywhere else. The combination of a 38% Dubai premium and a 12 to 13% SHFE premium, both existing simultaneously with the paper COMEX price, is one of the clearest possible market signals that the physical silver market is operating under significant stress. Stress that the paper price hasn't yet fully reflected. Let's get into a historical parallel that's been quietly surfacing in the analysis of several serious economists and market strategists, one that has genuinely dramatic implications for precious metals if it plays out. The Federal Reserve is potentially walking into what looks like a 1970s stagflation trap. And understanding what that means requires a quick history lesson. Stagflation is a specific, extremely difficult economic condition where high inflation and weak economic growth, including potential recession or job losses, happen simultaneously. It's sometimes called the worst possible economic combination because the tools central banks use to fight each problem individually make the other one worse. To fight inflation, the Fed raises rates, which slows economic activity and increases unemployment. To fight recession, the Fed cuts rates, which can reignite inflation. Stagflation puts the central bank in a genuine no-win situation, where every policy tool available makes at least one problem worse. The 1970s in the United States were defined by exactly this scenario. Oil price shocks driven by OPEC actions drove inflation extremely high, while the economy simultaneously weakened, leaving the Fed with no clean option. Precious metals, specifically gold and silver, performed extraordinarily well during the 1970s stagflation period, because they served simultaneously as inflation protection and as stores of value, when the dollar's purchasing power was eroding. Silver went from around $1.50 in 1970 to nearly $50 by 1980, one of the largest sustained precious metals bull runs in modern history, driven largely by the stagflationary conditions of that decade. Here's the current parallel. Iran conflict-driven oil price spikes created genuine inflation. That inflation is now stubbornly persistent, even as the jobs market shows signs of softening. Exactly the combination of conditions that characterized the early stages of 1970s stagflation. The Fed under Warsh, operating without forward guidance as we discussed in our Sintra speech video, is facing the same fundamental dilemma its predecessors faced 50 years ago. If they hike rates aggressively to fight inflation, they risk tipping a softening economy into genuine recession. If they hold or cut to support growth, they risk allowing inflation to become entrenched. This trapped position historically has been one of the most powerful, sustained drivers of precious metals demand ever documented. Let's zoom in on something technically very specific that Commerzbank published this week, because it provides a clear, actionable trigger point that you can actually watch for, rather than just absorbing abstract price targets. Commerzbank described a $90 year-end target as the cleanest bull case for silver, but crucially conditioned it on one specific technical requirement. Silver needs to achieve a weekly close above $65. Let me explain what a weekly close actually means, and why it's different from silver simply touching $65 intraday. A weekly close is the price that silver settles at when the futures market closes every Friday evening, after a full week of trading has played out. It represents where the market has collectively decided silver's fair value sits, after processing a full week's worth of news, data, and order flow. not just a momentary spike driven by a single news event, or a brief surge caused by thin trading volume. For technical analysts, a weekly close above a specific resistance level carries much more significance than an intraday high above that same level, because it demonstrates sustained committed buying across an entire week. Rather than just a brief, potentially reversible spike, silver's current price of around $61 means it needs to gain approximately $4 more, roughly 6.5%, to achieve that key 65 weekly close. With the specific catalysts ahead, the CPI report on July 14th, retail sales shortly after, and the FOMC meeting on July 28th through 29th, there are multiple opportunities in the coming weeks where the right data outcomes could either deliver that 65 weekly close or prevent it. Watching for that specific technical milestone, not just the daily price, but specifically the Friday evening settlement price over the next several weeks, is probably the single clearest, most actionable signal for whether the $90 bull case is actually within reach this year. Let me answer the question this video promised to answer, honestly, because giving you a direct answer is more useful than endless hedging. The honest verdict on Bank of America's $309 silver target is this. It is a real number emerging from a genuine analytical model. And it is also an extreme scenario requiring multiple highly favorable conditions to all materialize simultaneously, which means assigning it a high probability would be genuinely unreasonable based on current evidence. The more practically useful version of BofA's research isn't the $309 headline. It's the $135 base case. At current prices of around $61, BofA's own base case implies more than a doubling from here. That's not a crazy number. It's a serious, considered institutional projection that reflects the structural supply deficit, the COMEX physical stress, the China export restrictions, and the monetary backdrop we've covered today. What makes today's full picture genuinely different from just a single price target floating in isolation is the combination of multiple independent, credible signals all pointing in the same direction simultaneously. BofA's modeling, Citi's gold on steroids characterization, China physically restricting its silver supply to 44 companies, Dubai's physical premium sitting at 38% above the paper price, Shanghai's persistent 12 to 13% premium, COMEX registered inventory at 17% coverage in stress territory. The stagflation historical parallel, creating exactly the conditions where precious metals have historically performed best over multi-year periods. None of these signals individually guarantees any specific price outcome. Markets are complex and unpredictable in ways that make any single forecast uncertain. But when this many independent, fundamentally different signals all point toward the same structural tightness in the same market at the same moment, that convergence is genuinely important information for anyone making decisions about their silver position right now. The weekly close above $65 that Commerzbank identified as the technical unlock for the $90 bull case gives you a specific, watchable, near-term milestone. The combination of CPI, retail sales, and FOMC in the next 3 weeks gives you 3 concrete opportunities for that milestone to either be achieved or denied. If you understand all of that context, you're thinking about this situation with a level of sophistication that most casual silver content simply doesn't provide. So here's the complete, honest answer. Is Bank of America's $309 silver target real? Yes. It's a genuine institutional forecast grounded in a real analytical model, incorporating physical market stress, dollar dynamics, and structural supply deficits. Is it crazy? As the most likely near-term outcome, yes. It requires a very specific and extreme set of conditions all hitting simultaneously. As a directional indicator of just how large the structural upside potential in this market has become, it's worth taking seriously. The $135 base case, the Citi gold on steroids thesis, the China 44 company export restriction, the 38% Dubai premium, and the stagflation historical parallel all tell a consistent, coherent story about a metal whose physical market is genuinely under stress, while its paper price has been temporarily suppressed by macro headwinds that may be starting to fade. Watch that $65 weekly close over the next few weeks. If it happens, Commerzbank's $90 year-end target becomes the realistic discussion. And the conversation about higher institutional targets starts to feel considerably less distant than it does right now. If going this deep into the actual institutional research, the physical market mechanics, and the historical parallels is what you want from this channel, hit that like button, subscribe so you catch the CPI breakdown on July 14th, and tell me in the comments, does the $309 target feel real to you, or does it still sound crazy? I read every comment, and I'll see you in the next one.